0 o'clock if the world's most important commodity stops being traded mainly in the world's most important currency. The result will not look like a movie. There will be no dramatic overnight collapse. No single trading screen flashing the end of American power. It will look slower than that. More technical. More boring, at first. And therefore more dangerous. It will begin with fewer forced dollar transactions, more bilateral settlement deals, more oil sold in yuan or local currencies at the margins, and a little less automatic demand for the currency that has quietly sat at the center of the global financial system for decades. Then the second-order effects begin. More fragmented reserves, weaker sanctions reach, less seamless recycling into U.S. assets, and a world that starts feeling less dollarized without ever formally announcing that it has changed. That is how monetary gravity weakens. Not through spectacle, through habit breaking. 048 Welcome to Finverse Stories, where finance meets reality. And nothing is ever as simple as it looks. 053. The phrase petrodollar has been mangled by so many bad takes that it now lives in a strange place between genuine structural finance and internet mythology. Some people treat it like a secret switch that single-handedly props up the entire American empire. That is too simplistic. Others roll their eyes and pretend it barely matters at all. That is lazy in the opposite direction. The truth is sharper. The petrodollar did not create the dollar's dominance by itself, but it helped make dollar demand routine. For decades, oil, one of the most traded and strategic commodities on Earth, has been predominantly invoiced in dollars. That meant countries needing oil also needed dollars. Banks financing cargoes needed dollars. Central banks managing reserves kept dollars. Exporters receiving oil revenues often recycled those surpluses into dollar assets. The result was not just symbolism. It was reinforcement. The dollar became harder to escape because energy trade kept feeding it. IMF research still shows that the dollar remains dominant in global trade invoicing, and that commodities, especially oil, have long been predominantly invoiced in dollars. Even as renminbi use has grown from a low base, 1 to 59, to understand why this matters, you have to go back to the early 1970s, when the United States had a serious monetary problem. In 1971, President Nixon ended the dollar's convertibility into gold, effectively closing the Bretton Woods chapter of the post-war monetary order. The old promise had become unsustainable. America had issued more dollars than it could reasonably anchor to gold, and foreign governments were increasingly aware of it. Once the gold link was cut, the dollar no longer had the old metallic discipline behind it. It needed something else, not a literal replacement for gold, but a system of demand strong enough to keep the world using dollars anyway. Then the oil shocks of the 1970s changed the entire geopolitical and financial landscape. Saudi Arabia and other major exporters were earning vast dollar revenues, and those surpluses began flowing back through Western banks and into dollar assets in what became known as petrodollar recycling. Treasury archival analysis and BIS work both describe how oil exporters' surpluses were recycled into U.S. and global financial markets, helping reinforce the dollar's central role in trade, reserves, and international finance. To 58, this is the part that matters more than the slogans. After gold stopped backing the dollar, oil helped keep the world needing it anyway. Not because there was one magical secret treaty that single-handedly determined everything forever, but because the system increasingly worked that way in practice. If you are Japan, India, South Korea, Germany, or any major oil importer, and oil is priced in dollars, then you need dollar liquidity. If your banks finance those flows, they need dollar funding channels. If your central bank wants to stabilize external trade, it holds dollar reserves. If the exporters receiving those dollars invest heavily in treasuries, agency debt, bank deposits, or other dollar securities that in turn help support the depth and liquidity of America's capital markets. The power of the dollar is not just that people trust it. It is that the system is built to keep using it, often because avoiding it is more expensive, less convenient, or strategically harder. 346 That is why the petrodollar matters far beyond oil. It sits at the intersection of trade invoicing, reserve management, sovereign recycling, sanctions power, and financial infrastructure. When oil is sold in dollars, the transaction does not end with the purchase of the barrel. It creates habits. Importers hold dollars. Exporters accumulate them. Traders hedge in dollar markets. Banks clear and settle through dollar systems. Surplus revenues are parked somewhere, and U.S. markets have historically been one of the easiest places to park them because they are deep, liquid, and globally integrated. This analysis notes that petrodollars have often been recycled into U.S. Treasury debt and other U.S. assets, reinforcing the dollar's reserve currency status and its outsized role in global finance. That is not a side effect. That is part of the machine. For 30, now imagine that machine weakening. Not all at once, but meaningfully over time. Suppose more oil cargoes begin settling in yuan, euros, rupees, or local currency bilateral arrangements. Suppose more sanctioned states, commodity exporters, and Asian importers decide that avoiding dollar channels is worth the inconvenience. Suppose Gulf producers increasingly accept non-dollar deals for strategic reasons, not just pricing reasons. The immediate effect would not be the destruction of the dollar. It would be the erosion of automaticity. Fewer importers would need as many dollars for energy trade. Some reserve managers would diversify a bit more. Some oil export receipts would recycle into non-dollar assets instead of treasuries. Trade finance would become more regionally segmented. And the world's most strategic commodity would no longer reinforce the world's dominant currency with the same smooth consistency. The dollar would not fall off a cliff. It would lose one of the conveyor belts that keeps feeding it global demand. 525. That might sound abstract, but it has real consequences. One is reserve behavior. If oil trade becomes more multi-currency, then countries have a stronger reason to hold a more mixed reserve portfolio. Another is asset demand. If exporters receive a smaller share of their revenues in dollars, then some of the recycling that once flowed predictably into U.S. assets may gradually thin out. Another is transaction cost and fragmentation. A more multi-currency oil market may create more monetary autonomy for some states, but it also creates more hedging complexity, more regional clearing arrangements, and more currency risk in a commodity whose price already shakes the global economy. A single dominant trade currency has its privileges. It also has its efficiencies. If those efficiencies weaken, the system becomes more negotiated and more political. Probably not freer. Just Messier, 612, and then there is sanctions power, which is where the petrodollar stops being merely financial and becomes openly geopolitical. The dollar is not just a medium of exchange. It is a surveillance architecture and a leverage architecture. If a large share of global energy trade runs through dollar-linked banks, payment systems, and clearing channels, then Washington has extraordinary visibility and influence over those flows. That is why sanctions bite as hard as they do. It is not only because the United States is powerful in the abstract. It is because so much global trade, especially strategic trade, passes through systems it can monitor, pressure, or block. Shift some of that trade into non-dollar channels, and sanctions do not disappear. But the margin of evasion grows. Alternative payment rails become more valuable. Bilateral workarounds become more feasible. Rival blocks gain breathing room. The petrodollar is not just about demand for dollars. It is about how much of the world's energy trade passes through channels Washington can influence. 706. This is why the current moment matters. Reuters reported in March 2026 that the Gulf War is rattling the old petrodollar foundations. As Gulf states reassess the assumptions that held the old arrangement together, U.S. security guarantees, dollar-based oil pricing, and the recycling of oil wealth into American assets. Reuters also noted that non-dollar oil trades have already increased among countries like China, Russia, and Iran, and that Gulf producers are selling more to Asia while experimenting more openly with non-dollar settlement ideas. That does not mean the petrodollar is dead. It means the question has moved from fringe speculation to strategic debate. Once states begin treating de-dollarization not as ideology, but as contingency planning, the system is under pressure even before the numbers fully shift. 751. This is also where the so-called Petroyuan becomes interesting. Not because it is ready to replace the dollar tomorrow. It clearly is not. IMF evidence still shows that renminbi invoicing has grown, but remains modest relative to the dollar's global role. China does not yet offer the same degree of convertibility, trust, legal familiarity, and financial openness that the dollar system offers. But that does not mean the Petroyuan is irrelevant. It matters as a crack in the operating system. If enough oil trade begins settling in yuan, especially among sanctioned states, Asian buyers, or producers looking to diversify their geopolitical options, then the world becomes less cleanly dollarized. And once that starts happening at the margins have a habit of becoming precedent. 832. What makes this sharper is that the alternatives do not need to be perfect to matter. They only need to become useful enough for specific political and commercial purposes. That is how monetary fragmentation begins. Not with a rival currency proving itself universally superior, but with enough bilateral deals, enough strategic exceptions, enough commodity trades, and enough geopolitical distrust that the old automatic habits begin to weaken. Monetary empires rarely end because one day someone announces a replacement and the crowd applauds. They weaken when the routines that once made them unavoidable start feeling less unavoidable. When energy buyers can source elsewhere. When exporters can settle elsewhere. When sanctions targets can root around the core. When reserve managers no longer assume a single answer forever. 9:15 now. To be clear, the dollar still has massive advantages. It sits atop the deepest sovereign bond market in the world. It benefits from legal familiarity, network effects, derivatives infrastructure, broad convertibility, and an institutional ecosystem built over decades. Even if oil trade diversified more visibly, that alone would not erase those strengths. This is where a lot of overexcited commentary gets carried away. Oil moving partly out of dollars is not the same as the dollar losing reserve currency status tomorrow. The more credible story is slower erosion, less automatic demand, more fragmented settlement, slightly weaker reserve centrality, and a modest reduction in America's financial leverage at the margin. But in large systems, margins matter, especially when they weaken feedback loops that have quietly reinforced power for decades. 10:03, and that brings us to the deeper lesson. Reserve currencies are strongest when three things line up: trade centrality, financial depth, and geopolitical reach. The dollar has enjoyed all three. The petrodollar system helped bind them together by connecting energy trade to dollar liquidity, reserve demand, and asset recycling. If that bond weakens, even partially, the world does not become simpler or more stable. It becomes more divided, more negotiated, and probably more expensive to hold together. More currencies in oil trade means more political bargaining, more financial plumbing, more hedging, more duplication, and more room for blocks to form around payment systems rather than pretending the whole world still runs on one unquestioned center. 10:40. So what happens if oil stops trading mainly in dollars? Not apocalypse, not immediate collapse. Something more important. The world's financial system becomes less automatic. The dollar loses some of its forced relevance. U.S. power becomes a little less frictionless. Sanctions become a little less clean. Reserve management becomes a little more political. And the currency at the center of the system starts to feel less like gravity and more like one very large player in a more contested field. That is the real implication. The petrodollar matters because it turned energy demand into financial gravity. And if that gravity weakens, history suggests the result will not be freedom. It will be fragmentation. 11:19. If this gave you a new perspective, hit subscribe. The financial universe has stories to tell, and we're here to uncover them.